What is going on, guys? My name is Winston. You guys really enjoyed my last video on Lemonade stock, so here I am back at it again, but this time we're talking ARK Invest's comment on Lemonade, we're talking Q2 earnings, and we're talking about Q3 guidance. So let's hop into it. So first off, here's what ARK Invest had to say about Lemonade.
Lemonade, are they or will they be able to disrupt the more traditional insurance industry?
Thanks, Tom. I can take this one. Short answer, no, not as we currently see it. Our early read on Lemonade is it has a very low moat in comparison to other insurtechs that leverage more unique technology stacks. Another one to think about here is Root Insurance. I would check that one out. It's a private company, and it really differs from what Lemonade does. The other concern that we have over Lemonade is its dependency and use of reinsurance to stabilize its margins. That has a lot of, there's a high risk in doing that, but also great reward. And we're not too sure as to whether or not we're, just willing to look at that any further. But the reason that I say no to Lemonade disrupting the insurance business is that what they've really done is take a friendly UI and friendly UX and put it into a legacy insurance or essentially wrap it around a legacy insurance business. So nothing too much differs from what a Lemonade renters and policy insurance offers versus State Farm or Allstate. It's just this friendly UI UX that's seen a lot of media attention, and the reason that we're talking about it today.
Now, I think ARK Invest is totally right when you say they have no moat. I mean, even Lemonade seems to suggest insurance is an easy space to get into. And they said they picked insurance because it looks disruptable, even though they don't know much about insurance. Here's the clip I'm referring to.
Daniel and I have both been tech entrepreneurs for 20 years, and it just so happened we were looking for the next big thing. So we started looking at different industries, but when we came to insurance, we stopped.
We had found a destination. The more we thought about it, the more we realized that insurance may be the largest disruptable industry on the planet. Even though neither of us had come from the world of insurance, we found three things in insurance that just about never come together.
Now, I think it's normal for Lemonade not to have a moat because a moat doesn't develop itself overnight. It takes a long period of time to develop. But the real question is Lemonade really going to develop one? Let's take car insurance, for example. How is Lemonade going to compete against Root or Tesla Insurance, who are both collecting data straight from the source, which is the driving behavior? The answer is they won't be able to compete unless they start collecting data themselves or at least partner up with other insurtechs for that. Now, moving on, ARK Invest gives the example of Root having more moat than Lemonade. Now, Root, to give a quick background on what they do, is they offer car insurance, and that's relevant because Lemonade is also looking to get into car insurance. To get a quote from Root, you have to do some test driving for a few weeks with their app on, and their app is basically going to evaluate how good of a driver you are and then offer you a quote reflecting your driving abilities or outright just deny you if you're a horrible driver. So why would customers go with Root instead of some other insurance company? Well, at the end of the day, it boils down to the price. So ultimately, being a disruptor in insurance is going to boil down to offering cheaper prices, a great product, and of course, being profitable. Now that we've established price to be the key thing for disruption, what is actually going to drive them lower? Well, there's three things: a better loss ratio, lowering your operating expenses, and of course, having a higher investment income. So let's start with improvement in the loss ratio. So this ultimately boils down to two things: the amount and quality of your data and the accuracy of the model you created to feed that data into. So at the bottom, you got legacy insurers feeding the few data points they collect into risk pricing models that are built by actuaries. In the middle of the pack, you got Lemonade, who collects 100 times more data and feeds them into an AI that is continuously improving its risk pricing models. And at the top, you got companies who use telematics to monitor the asset directly and then feed the data into models that are again, either built by actuaries or an AI. So these are your Tesla Insurance, your Root Insurance, and Hippo, for example. So in terms of potential to have a really good loss ratio, I think Lemonade falls in the middle of the pack here. Second thing is lowering your operating expenses. This is honestly where I think Lemonade can outshine everyone else with the use of their AI. I mean, just look at their policies per employee. In 2019, they were at 3,165 customers per employee. In 2018, they were at 2,500, and look at what the legacy insurers are at, between 625 and 1,200. And mind you guys, the legacy insurers, they have tens of millions of customers, whereas Lemonade hasn't even reached its first million yet, which means the policies per employee is going to keep going up. So that's one area where we're going to see the impact of economics of scale, and another one is their marketing, which I'll touch on later. And last thing that will drive prices lower are having higher investment income. And for this, there's not much I can say from a Lemonade standpoint because they are reinvesting most of their capital in growth, so they'll have really little investment income. If we look at the US property and casualty industry as a whole, 90% of their profits between the years of 2013 and 2018 were from investment income. Now, insurance companies usually invest in low yield, low risk assets, and I would imagine Lemonade does the same thing here once they mature. The only issue is interest rates have been extremely low, which also means your safe investments will yield little to no profits. And that's an issue for your large insurance companies who have matured, as this cuts directly into a large chunk of their profits. So overall, if I were to put Lemonade on a scale of not disruptive to really disruptive, based on their ability to offer really low prices, I'd say they're about in the middle. At the end of the day, the biggest factor to offering lower prices is going to be having more specific data to price risk with, which Lemonade, as they stand right now, do not have. Instead, they have to rely on their machine algos to find new correlations using a bigger pool of data points. Now, one thing that they have going for them is they don't need to have as many employees, which means they have much better operating leverage as compared to other insurance companies. But the thing is, as their revenue increases more and more, moving that profitability needle is going to depend more and more on risk pricing. Now, at the end of the day, Lemonade definitely do have much more room to grow, and I do think they're gonna acquire more and more market share, but as they are right now, I don't think they have what it takes to be the number one player. So that's my opinion on their fundamentals. Let me know what you think down in the comment section. Now let's move on to Q2 earnings. Since Lemonade is a high growth company, here's what I'm looking for. So I'm looking for growth in terms of premiums per customer and number of customers. I'm looking for improvements in their AI's ability to price risk, and I'm also looking to measure the scalability of their business. Alright, so let's start with measuring growth. First thing we want to see is how well they are growing, and we can measure that through the in-force premium. So it's up 115% over Q2 of last year, and if we break this down a little more, they're at 814,000 customers, which means they've acquired about 85,000 customers over the last quarter. That's pretty much exactly on par with their historical average, so they've been pretty much maintaining linear growth. But what's actually really impressive about this is they actually cut down all their marketing costs this quarter and still managed to maintain their growth. For the entire year of 2019, their acquisition cost was about $266 per customer. Now in Q1 2020, the acquisition cost per customer actually dropped down to $222. Now in Q2 2020, they acquired 84,835 customers with 16.1 million in marketing expenses. That sets their acquisition cost per customer at around $190 per customer. So that's pretty crazy. We're starting to see their marketing efficiency really pick up, and with their premium per customer increasing this quarter yet again to $190, any new customer basically pays itself back within a year. Second thing I'm looking for is measuring the efficiency of the AI. If you want to precisely measure that, we have to look at the gross loss ratio. Now, their gross loss ratio is down to 67% from last quarter's 72%. Now, if you look at the trend over the last quarters, the AI has been pretty much improving every single quarter, which is great to see. Now, one of their execs said that they were targeting a loss ratio between 60 to 70%. So I'm not sure how much more of an improvement we're going to have from here. Now, the average loss ratio for property and casualty insurers seem to lie around the 40 to 60% range, but that's sourced from Wikipedia and there's no actual source linked. A second source seemed to say between 30% to 60% is an okay loss ratio. If that's really the case, I'm hoping Lemonade's AI keeps improving its risk pricing significantly, or else they stand no chance at turning a profit while keeping prices low. And final thing that I want to look at is how they've been scaling their business. So the best thing to do here is actually take a look at their income statement and see how their revenue and expenses rise. We're going to ignore the loss and loss adjustment expense since this is not an operational expense. So we're left with one, other insurance expense. These are for the most part small commission fees and credit card fees. Two, sales and marketing. Three, technology and development. And four, general and administrative, which for all intents and purposes will be the cost of employees and consulting fees. Now these operating expenses total up to 30.1 million this quarter, whereas last year it was 26.9 million, which is a 12% increase. If we look at the revenue during the quarter, it went from 13.3 million to 29.2 million. So for generating over double the revenue, your operating expenses only increased by 12%. This is a crazy year-over-year improvement, and it is to be expected since Lemonade's growth only affects sales and marketing and employee expenses for the most part. Now to conclude, at the end of the day, all we have to see here is that their adjusted EBITDA has improved from a loss of 23 million last year to a loss of only 18.2 million this year. So overall, we're clearly seeing the trend. As Lemonade is growing, their expenses are becoming a smaller and smaller portion of their revenue. And that's because one, their loss ratio has improved, so they pay out less in claims as a proportion of written premium. Second, their marketing is becoming more and more efficient, so their acquisition cost per customer is getting cheaper and cheaper. Three, the premium per customer is increasing quarter after quarter, which means that customers are naturally upgrading their plans. And last, the number of customers per employee is increasing, so they're saving on operational expenses here. So overall, this earnings release was as expected. I think it's great that Lemonade is getting closer and closer to profitability as they scale. The only thing that really surprised me was how fast they're improving their marketing efficiency. Like, I have no idea how they're doing that. If I had to guess, it's probably from organic growth, since their net promoter score is actually insanely high. Anyway, let's look at their guidance for Q3. Now, as we roll over to the third quarter, we got quite a few things kicking in, so let's start with pet insurance. So Lemonade has launched their new pet insurance product starting at $10 per month and offering a 10% discount to existing customers if they bundle up their policies. Now what's great about adding a new product is you've already got a pool of potential customers from your existing customer base to sell to with a much lower cost of acquisition. Now I'd be curious to see what kind of data Lemonade collects to feed its machine learning algos, because from what I saw from trying to get a quote, they ask the usual questions like, the age of your pet, the breed, the location, etc. So I'm not expecting the loss ratio for pet insurance to start off horrible, but I'm not expecting it to reach incredible levels either, unless Lemonade's machine learning algos find all sorts of new risk correlations. Now just know that whenever Lemonade launches a new product, they are for sure going to start off with a horrible loss ratio, so just keep that in mind, as this will for sure slow down their path to profitability. So the way I see it right now is the addition of pet insurance is just another product that Lemonade is just slapping on because it's easy and low risk to do. This also falls in line with their main goal, which should be, as of right now, to grow their revenue as fast as possible while taking advantage of their operating leverage. And overall, I'm not expecting crazy high revenue for that, as pet insurance is only a 1.7 billion industry in North America, and Lemonade's Q3 guidance for revenue isn't increasing dramatically. Alright, now let's start talking about their new reinsurance structure. As I mentioned in my previous video, they will be leveraging 75% of their business with proportional reinsurance starting this quarter. This will impact their revenue and their gross margin, and let me explain. So their revenue guidance for next quarter is only 15 million, which is about 50% less than what they just achieved last quarter. That's because the amount of revenue and losses that are ceded to reinsurers aren't included in the GAAP income statement. So moving forward, the main revenue stream will be from premiums that weren't ceded and the ceding commission income. Now, the main motivation for going with a business model like that is to take advantage of the increase in capital efficiency that it provides so they can reinvest in growth instead. They state that every dollar of surplus is now expected to support roughly 3 times the premium amount that it did in Q2. This means they just freed up a lot of capital to reinvest in growth. So what they've actually done is sacrifice their short-term revenue in order to grow at a faster rate. So it'll probably only be a few quarters before the revenue catches up to what it used to be. So remember last video I was wondering if they wanted to maintain their current growth rate or increase it. Well, now we have our answer. Now with the introduction of reinsurance, this messes up their GAAP KPIs, so that's why you see this sudden increase in gross margin. So moving on, we should be watching their adjusted KPIs instead. So let's look at their guidance. So they have 14 to 15 million in revenue, and that's to be expected. Their adjusted EBITDA loss is forecasted to increase to 32 or 33 million. Mind you, for the first 6 months, the adjusted loss was 40.6 million. And frankly, the reason why I think it's increased so much is I think they're planning to increase their marketing and admin costs to grow faster. So we can probably expect customer gains in the 6 digits per quarter moving forward. Now, I like to use a cash flow statement to understand how much cash is actually lost every quarter as they grow. And we can see that from year to date, it's only at 35.3 million, and this figure is comparable to last year's 37.7 million, despite running a much larger business. Now, going forward with Q3, the net cash used in operating activities will probably increase, so if you wanted to monitor their cash burn rate, there's the numbers you should be using. Now, to conclude, I don't plan on buying Lemonade stock anytime soon. I think as they are right now with their current fundamentals, I think they won't be number one disruptor, even though they do have much more space to grow. And at the current valuation, I think the stock is too expensive, even if I factor in a couple of years of growth. Now, that being said, remember this is not financial advice. I have no idea what I'm talking about. You guys should be letting me know down in the comment section below what you think, and I'll see you guys next time.